In this episode, I'm going to show you two really good mutual funds across different investment classes and different risk appetites. There is a lot of talk right now and everyone talks about investing in index funds. I think you guys have heard about that as well, that everyone says index funds is the best right now. It is a passively managed fund. The tracking error is also low. The expense ratio is very low. Expense ratio is basically the fee that the mutual fund company takes from your investment, right? So they say that it's very good, and most of the fund managers cannot beat Nifty. 99% of the fund managers cannot beat Nifty. That is why index funds are great. Now, index funds are good by design, no problem at all. But is it the best for all investment classes? No, it is not the best for all investment classes, right? So for someone who wants to take more of a risky avenue or a risky appetite and wants to take it for a slightly longer period of time, I would not go for an index fund. I would go something for a mid cap or a small cap fund. So the first profile we're going to talk about is someone known as a lower risk investor. Now, what constitutes for a low risk investor? This can be someone already in his 40s or 45 going towards 50, has a lot of liabilities already on him. Maybe he has a loan, home loan, car loan, etc. He has all of that. Not built enough emergency fund as well. And tomorrow, if something goes wrong, he might want to remove the money out of the mutual fund. That means it's not a very long term, invest and forget compound kind of a scenario. So he might liquidate that corpus and use it for something else. So for this, I term them as a low risk investor, right? Now, when you look at a low risk investor, they can invest in two different avenues, right? The first avenue that you can invest in is in fact the index fund. Now, a lot of people do this mistake where they invest in an index fund and then they invest in a large cap fund as well. Please understand, the index is made up of the top 50 large cap companies that are there in India, right? That is why they hold so much weightage in the index fund. So investing in the index fund and investing in large cap kind of makes no sense, because you have most of the companies that are overlapping between each other. So I would suggest definitely take up an index fund. And if you ask me, there are some very good index funds, but I would go slightly safe because I like investing in companies which I know will be there for a very long time or have been there for a very long time, right? So I would just go for a very simple one. There's no need to put too much brains into this. Always choose a direct plan. So a good one would be something like an HDFC index fund direct plan, Nifty 50 plan, right? Currently, this is going with a fund size of approximately 10,000 crores has been invested in HDFC index fund, and the expense ratio is 0.2%, which is very, very, very cheap. And it basically tracks your index. Right now, obviously, the index is doing really well. The market is going up. Everything is doing well. So obviously, this is performing well as well. And you can do a quick SIP into this at whatever amount. There's a lot of information about this and there's a lot of competition as well. There's even Axis Nifty 50. Now, there's not much difference between the index funds because they're pretty much going to be the same returns across. So I would go for something that has a good fund size or a good name like an Axis, HDFC, SBI, which I know will stay there for a very long period of time. Now, the second thing I would recommend is maybe investing in a mid cap fund or a flexi cap fund. Now, for a mid-cap fund, something like a Kotak Emerging Equity Fund Direct Plan, which is a mid-cap fund, looks interesting. Again, it has a 0.38% expense ratio. The last one had 0.2. This has 0.38. So it is slightly lower in the entire mid-cap trajectory. The fund size is around 36,000 crores. The NAV, which is net asset value, is sitting at 112, right? And if you look at the all-time returns that is there, it has beaten the benchmark index, which is the Nifty benchmark index, consistently over a long period of time, right? This is what I say, that yes, 99% of the fund managers lose money and the index wins, but the 1% that actually win consistently over time and give it enough time, then you will see that they actually win over time. So even if I start checking in shorter time frame, as you see, the Nifty has definitely won and the scheme has lost. But if you can start investing for a longer period, like even for 3 months, you will see that this has given slightly more returns than the Nifty mid cap index. 6 months definitely more, and the longer you go, obviously the longer the deviation keeps increasing, right? You can also do your SIP returns here. You can also calculate your returns here. Like if you had invested, what would it be right now? If you had done an SIP 10 years ago, what would it be right now? And another very interesting thing to see in mid cap funds is what are they holding. So you can actually go here, click on detailed portfolio analysis, and once you do that, it will show you all the stocks that are currently there, the top 10 holdings of this, like Supreme Industries, Solar Industries, Persistent, Oberoi and Persistent recently went up as well. Sheffer, Cummins, all of these companies recently have started shooting up. Obviously, the market is also doing really well. That is why it is shooting up as well. And for a flexi cap, I would go for just one. There's always one which is very famous in the flexi cap, which is the Parag Parikh Flexi Fund itself. So I would technically go for that. There's not much innovation there, and they have been beating the market for a very long period of time. So that is what I would do for a safe investor. Now, if you ask me, Shashank, what would it be for a medium risk investor, right? Now, what is a medium risk investor? Now, this guy is a slightly younger person, has low liabilities, can wait for a long period of time, minimum 10 to 15 years. I don't need to remove the funds at all, and has enough income to support this. Okay, for these type of investors, you would go slightly more aggressive, because I don't want you to invest in index funds or large cap, because the returns are okayish. And if I'm ready to wait, then might as well take that extra risk if I'm ready to wait, right? So for this, I would put almost 70% of my funds into a mid cap fund, and maybe 30% to 20% maybe in a small cap fund. Small cap fund is slightly more risky, slightly more volatile, and the market cycles a little longer, but mid cap fund over a period of time, I've seen in the last few years, if you see, there are a lot of companies in the mid cap becoming large cap, right? A lot of small cap companies have become mid cap, and a lot of mid cap have become small cap. A lot of value migration is happening towards this. So for a long period of time, and looking at India's growth story, I would definitely take a mid cap heavy portfolio if I'm in the medium risk category. Now, the third risk category, which is the high risk category. Now, this is for people who are very young. Let's say you're 24, 25, just started earning, or you just have pocket money, right? And you want to directly now build for retirement. You're like, Shashank, boss, I am going to become a crorepati. I'm going to retire right now. At the age of 55, 60, I want to retire, but I want to build a corpus from the age of 25. I'm going to let 35 years of compounding take care of me, right? For those type of investors who are extreme long term, who will never touch that money and don't want to even look at it, and it can be a small amount, it can be 500 rupees, 1000 rupees, 1500 rupees every month SIP for you, because you're investing 30-35 years, I would go straight up small cap and either micro cap or mid cap, right? But it would be a very small cap heavy portfolio, anywhere between 60 to 70 in a small cap. Now, if you ask me which small caps are good, I'm again going to go with something that has stood the test of time. That is Nippon India Small Cap Fund Growth, 41,000 crore AUM. It has been there for more than 20 years. It's been there from a very long period of time, and if you track the returns over a long period of time, it has given a good amount of good amount of returns from a SIP perspective as well, right? So even if I do an SIP and say I invested only 1,000 rupees per month, and I've held it for, let's say, last 10 years, then it would give me an annualized rate of return of 26%. But again, don't get fooled by just 26%, mainly because, as you see, the deviation after COVID has gone up quite significantly, because we have entered the bull run here, right? And if you see in the past, yes, there has been significant outperformance from the small cap index as well, but the deviation is slightly higher. So I would not take 26%. I would take anywhere between 18 to 20% as an annualized return. I'll be very happy, because you have 35 years to compound at 18 to 20% returns. That will be great, right? This is the age-old company that has been there for a very long period of time, but there is another company that has been doing well. Let me just show you that, which has started coming up right now. You might have heard of it as well in the small cap space. I think that is called Quant Mutual Fund, right? So Quant Small Cap Fund, as you can see, they don't have a very good historic performance chart, but if you look at it from the last 3 years and 5 years, they have been beating even the top guys, right? Another thing in Nippon, I want to tell you, the expense ratio is quite high. It is 1.53. Because they achieve that kind of returns, they take 1.53. Remember, the mid cap was 0.3 and the 3.8, and the other one was 0.2. Small cap usually has a very high expense ratio, but if you stay invested for a very long period of time, technically it doesn't matter, and you don't withdraw the fund, so you keep your tax benefit as well. Another very interesting one that has recently released, I don't know if you have heard about this, but Motilal Oswal recently released something called as a micro cap index, which is going to be even more riskier than the small cap index, but this is again ultra long term, right? This is micro cap, extreme. As you can see, it's a very, very, very high risk portfolio. I would be little worried about it, but again, if you're planning to invest for a very, very, very long period of time, then this is okay, right? This is currently at a NAV of 13. It just released now, very recently. The NFO came out. Fund size, as you can see, is only 573 crores, so it's very small. SIP amount starts at 500, and these are the companies that they have currently invested in. In fact, some of these companies are really, really good, and I've made money out of these companies as well, right? So these are some things that you should definitely understand while investing in mutual funds, and the expense ratio is quite quite low actually compared to a microcap fund, but because it's an index fund, it becomes a passive fund, so they actually replicate the microcap index, so it's a 0.35% thing. Now let me show you my mutual fund portfolio, which I've just started investing recently, right? Till now I was not putting mutual funds because I was like, boss, stock is king and I've been investing in the stock market, but I said let me get another balance, margin of safety, and I've just recently, last few months, I've just started investing. So this is my coin for that investing purpose. So as you can see, I'm only investing in two things. Now both of this, please understand, is my ultra long term investing. With this Motilal Oswal Nifty Microcap Index is something that I'm just investing right now for my retirement, straight away retirement. I don't care, I'm going to use this when I'm 60 for me and my wife. That's it. It's just for me and my wife to enjoy. And Quant Small Cap Fund is a fund that I recently started. Basically, if I'm going to get a kid tomorrow, I don't want to take the tension of getting them married and then sending them abroad for education. So this is something I've started right now. I've started this quite recently. So it is around 10% up already and 11% up. This is just recently. As you can see, it's not a very big portfolio, but I've just started doing this, and only these two I'm doing. No large cap, no mid cap, no index funds. So guys, again, as I said, please talk to your financial advisor before doing anything. Don't simply go for blindly for returns, because the returns actually change. Doesn't mean that past returns have been so well that the future returns will be so well. Please keep your expectations really intact, right? Don't go for the current returns that it's showing, which is 20, 25, 30, 35%. You might end up in the long scheme of things, if you take 20, 25, 30 years, you might end up with 15 to 18 to 20%. That is good enough. That is very, very good enough. So be very happy with that. And again, if you're planning to invest for a very long period of time, then you can go for slightly riskier assets. Again, go with good names. Don't go with some shady names. Don't experiment too much with this, because pretty much everyone is going to give you similar kind of returns, right? So this was a very quick video on the two mutual funds that are very good for different asset classes. So if you like this video, click on the like button, share it with your friends who would like to see it, and also don't forget to comment below if you have any more topic suggestions that I should do. I'll quickly come back and do them for you. This is me, Shashank, signing off. Take care and don't forget to subscribe. See you guys. Bye.